All right, do you live stream live or do you live stream later?
Later.
Wouldn't help me in class then. I was going to say if it didn't start, text me and I'll make sure. But if you live stream later, it won't help a bit. All right, so what is wages per day? 5 into 2000s, how much?
400.
All right, 400 per day. All right. Now, if today were the end of the accounting period, how many days has went by this week? Well, today's Wednesday. Let's say that 3 days, work days have already passed. 8 to 4, 8 to 5. All right, 3 days. So what is 3 times 400? 1,200. Now you'd have to make an adjusted entry for wages for that. So what would you debit for this 1,200? What would you debit? Wage expense and credit, wages payable. Now you'll have that on your test a couple of times. All right, so hopefully you heard what I said. All right, chapter 4 is completed the accounting cycle. I've got a couple of students, I think one the day class, one the night, and each one of them lives 2 hours away. And they've got it set up with their local library to take a test. But, you know, I have to talk to the library and make sure it's a real person and have a fax number for that library, make sure it's a real library and so forth. Then I will fax the test and talk to that librarian that proctors for us. Okay, the complete accounting cycle. Describe the flow of accounting information from the unadjusted trial balance into the adjusted trial balance in the financial statement. Now, our first step of the accounting cycle was, and this may have been a multiple choice question, was to make a journal entry. What was the second step? What's the second step of the accounting cycle? No. Let's do the last. All right. Now, those steps are listed. Can you find them? Chapter 4, the first few pages. The steps should be listed. Should be. Somewhere on the first few pages. All right. What would you do second? You would post. What would you do third? You do a unadjusted trial balance. What would you do fourth? You do the adjustment. Come up with an unadjusted trial balance. Now that's where we are through chapter 3. And then the financial statements does come in there. Now we can take the financial statements from the unadjusted trial balance, the adjusted trial balance. And then there's one more set of entries that we have to study. But here then, describe the accounting cycle, illustrate the accounting cycle, explain what is meant by fiscal year. I just did that. Fiscal year is any 12 months. A calendar year is January 1, December 31. All right, working capital and the current ratio. Now we're going to use a spreadsheet. It's the 10-column worksheet. It will be in Cengage. I may have to hand one out to you in class. Come next Wednesday, we'll go through it. But from this 10-column worksheet, the first two, this column, the first two is the unadjusted trial balance, then the adjustments, then the adjusted trial balance. Now, if we did the whole 10-column worksheet, we'd have the income statement balance sheet. But from this adjusted trial balance, we do an income statement, we do a capital statement, we do a balance sheet. And most of those things are doing on test tonight. All right, since you have these statements tonight, and I give you a whole list of accounts, this is sort of like review. All right, where does office equipment go? Which statement? There's the income statement, the balance sheet, the capital statement. Where does office equipment go? Balance sheet. Utility expense, income statement. Accumulated depreciation, balance sheet as a minus to equipment or building or what have you. Unearned rent, balance sheet. It's a liability. Fees earned, income statement. Drawing, which one? No. Drawing does not go on the balance sheet, does not go on the income statement. You got one more shot. Capital statement. Drawing goes on the capital statement. All right, revenue, income statement, just like fees earned. Supplies, balance sheet. An income statement, which you have on the test tonight, all these, put the two things on it. Put revenue and put expenses. That's what you put on the income statement. Guess how you know if it's an expense or not? It has the word expense at the end of it, okay? So don't miss a little old income statement tonight on the test. Statement of owner's equity, you'll have that tonight. You start off with beginning owner's capital account. You add net income, and you subtract drawing, and you get the ending balance. And here's a picture of it. Beginning capital or additional investment. In some cases, you had no beginning capital and you had to invest. You had net income, subtract drawing, capital increased, $28,105. Another owner's equity. Now the balance sheet says the assets are divided in two sections: current, property, plant, and equipment. Liabilities, current and long term. Now, current liability is something that has to be paid under a year. A long term is over a year. And that's called a classified balance sheet. A classified balance sheet. And once again, your assets has to equal your liabilities plus owner's equity. All right. Liability is $1,390, owner's equity $28,105, assets equals owner's equity. Notice your dollar marks at the beginning of the column and before a sum or a difference, double line under your final answers. I won't take off for format on this test. Current assets, cash, accounts, notes, that's under a year is current, or any kind of notes receivable, supplies, and prepaid expenses. Property, plant, and equipment, sometimes called fixed assets or long-term assets, is your equipment, machinery, and building. That's what you use to produce an income. So examples of liabilities, they all have payable after them, except unearned fees. More than a year is your long-term liabilities. All right, is this a current asset, property, plant, and equipment, current liability, long-term liability, or owner's equity? How about Jason Capital? Owner's equity, notes receivable due in 6 months. Current asset, notes payable, long-term liability, land. Which one? Fixed asset, property, plant, and equipment, cash. Yeah, but which one? Current. Unearned rent. C, current liability. Accumulated depreciation. B, property, plant, and equipment. Accumulated depreciation has a credit balance. It's called a contra account. We know assets have a debit balance. A contra account has the reverse balance. Accounts payable, current liability. You need to know that for your test tonight, but it's nothing new. All right, permanent accounts. Permanent accounts are your assets, liabilities, and capital. Your balance sheet accounts are permanent. Hopefully you have zero balance liabilities, but you have a permanent account. They carry forward from year to year. Now, temporary accounts are the other three: drawing, income, and expenses. Now, if you start off January 1st, 2019, you have zero in net income. You have zero in your expenses. You have zero in draw. So hopefully you have some assets, cash. You probably have some liabilities, and hopefully you have capital. Don't you're bankrupt. So the balance sheet accounts are permanent accounts, sometimes called real accounts. Temporary or nominal. Revenue expenses on the income statement plus drawing. This chapter has one new kind of entry. It's called closing entry. Now, our temporary accounts, we want to give a zero balance. What is the balance in revenue? What's the balance in revenue? That's a credit, don't it? To get rid of it, to give it a zero balance, what would you have to do with it? Debit. Expenses have a debit balance. What would you have to do to get rid of it? Credit. That's what a closing entry is. You close out all these accounts. In some books, it's the last step of the accounting cycle. But some books have reversing entries, which is the last step. Closing process. Revenue expense account balance are transferred to the owner's capital. The balance of owner's drawn is transferred to owner's capital. But let's look at what a closing entry looks like. These are T accounts. We're going to take fees earned as a credit balance. We're going to debit fees earned. 16,840. We'll have to probably debit capital. And here we're going to have to debit capital, a credit drawing, and debit capital. Some books use so here's two closing entries. Some books use 5. They use a dummy account. This book does not use that dummy account called income summary. Here, we debit our revenue to give a zero balance. We credit our expenses. The difference goes to capital. We debit our capital credit draw. Two closing entries. And that is new in this chapter. We'll work on it next week after we look at your test grade. These have to be posted. We're not going to take time to do this, but with debit fees earned, we'd credit wage, rent, supplies, miscellaneous expense. We would credit draw and debit capital. That would be the two entries to close accounts. There is a post-closing trial balance. There'll be no revenue, expense, or drawing on it because we closed them out. So it will have your balance sheets account on it. That's what you start the next accounting period with. So post-closing trial balance is the last step. Accounting cycle ends. Like this one has 10 steps. Transactions are analyzed at journal entry, post, unadjusted trial balance, adjusting entries number 4, spreadsheet number 5, number 6, journalized adjusted entries, number 7, do the adjusted trial balance, number 8, do the statements, 9, close, 10, post, post-closing trial balance. Now, you should be able to keep books after chapter 4 for a service business, okay? We'll cover those in more detail later. Just more examples. Liquidity, that is your current assets. You're solvent if you can pay your debts. If you can't, you're bankrupt, insolvent. All right, this is one I wanted to get up to. A WC is equal to current assets minus current liabilities. WC, working capital. You know, sometimes we have language, even word differences. For example, there was a ranger in California wanting to sell his range. All right. Now, somebody from a European country came over and looked over his range. So that fellow went back. Of course, cell phones were in at that time. I don't think text was an email, may have been, I'm not sure. Anyway, he contacted the California ranger and asked him how many WCs was on his property. Well, the California ranger knew what WC meant to him. Now, in Europe, in some of the countries, what does WC stand for? Water closet, right? And what's a water closet in some European countries? Toilet. Bathroom. WC. What do you have in Spain? Bathrooms or WCs? Both? All the same thing, right?
Bathroom name for the bathroom. Just this.
male, female, I guess. Whatever, anyway, we established the board, and WC could be a bathroom, right? But this farmer didn't know that WC meant bathroom. He said, we have one 10 miles down the road. That was like on a ranch, and the nearest bathroom is 2 miles down the road. He said, it will seat 100 people. That was like a bathroom, seat 100 people. He said, once a year, we have a picnic. Looks like to have a picnic in the bathroom. And he said, my daughter got married there 2 years ago. So how would you like for your daughter to get married in a toilet? Do you know what the former thought WC meant? Wayside chapel. Okay? So we have difference in terminology sometimes. For example, capital in economics is machinery and equipment. And here, capital is the owner's investment that buys machinery and equipment. All right, so WC, working capital in this situation, okay? So if the current assets is 7745 and your liabilities is 1390, you've got spare cash of 6355 to work with. That's why it's called working capital. And your current ratio is your current assets over your current liabilities. In this case, it'd be 5.6. If a company has 2 or better, it's usually good. 2 or better is usually good. All right, we're going to quit on chapter 4. If you're out there, it's a short class. I'm going to stop. I will stop live streaming simply because there's no need to live stream during a test. So, Morgan, I know you're one out there. Let me know when you can take this test. If you put it off too long, I'll have to give you 100 multiple choice for this first test. We don't want to do that.